guys, I'm recording this a bit later today. It's lunchtime here in Australia, but just wanted to show you our website is finally completed. We have had it for a couple of months, but we've been adding things such as prop trading, which is now fully available. Excuse me. So there's a bit of an explanation on that there. The course overview, what you can learn, the education side of our business, and trading analysis. That's where you go to the dashboard and see how your trading metrics are going. But in here we've got various prop accounts with various maximum limits and obviously different costs. It's all US dollars. Online course, and this support, you can get a support package which is also available for you. So yeah, we're pretty proud of what we've produced there. So let's go and have a look. One thing I wanted to show you was this chart here, which we're noticing overnight, or certainly this week, that the markets are taking a bit of a turn. We can see some PMI data here from the US, manufacturing and services, not yet in contraction. Under 50 is contraction, and but certainly lower than expectations. And that chart, if we have a look at the manufacturing, it's certainly sort of heading in that direction. That's last sort of 6-7 months or so. And similarly, Germany and also had a big miss, as well as France. So it seems that inflation and the raising interest rates, high inflation, and the resulting spike in interest rates certainly having an effect on the global economy, and that recession is getting closer. That's why we come to this, which is what we're seeing is a pretty high correlation between the copper gold spread and the US 10-year yields, but there's quite a big gap there to go, that the bond yields have to come back down. So whilst the Fed is raising rates, they're looking to pause in October, and maybe even there's now thinking that we might get a rate cut earlier in the year. It depends on how inflation goes, but certainly that disparity in price action here, with copper and gold going this direction and bonds yields going in this direction, something has to give, and certainly it's not going to be copper and gold getting stronger in the current environment. We can go and have a look at price action. Let's just note that the US bonds, as we were talking about earlier in the week, most likely going to be heading this direction. That's the yields just coming off the 3.5 mark. Found a sort of bit of a support there at 3% and bounced, and we see that kind of action in US dollar didn't really do much. It's still sort of floating around the 104 mark, and we have euro dollar not doing much at all, and Aussie dollar a little weaker thanks to the weakness in commodity prices. Pound not doing much at all, and yen getting a little stronger as a bit of a safe haven bid comes on. CAD, yeah, it's going to be a tough one. And dollar Swiss, after they raised interest rates, have seemed to have found a bit of support here. Nice M looking back action there. Not a huge fan of trading the Swiss, but a break at that level might be an opportunity for you. Going to commodities, we'll just note that crude oil is getting weaker. Natural gas is also getting weaker, and despite Germany going into a high alert this week on the fact that they expect Russia to cut off supply to the Germans, copper in almost free fall, the lowest it's been since 2001. And this is a good indication that a recession is coming, because the lack of demand for copper, certainly a bit of a support level there, but that's good indicator of economic growth. When the copper prices are coming off, obviously we're getting closer to recession, and certainly that doesn't bode well for iron ore prices or commodity prices. You can see iron ore here, coal in terms of energy still holding up, but coal, natural gas is coming off. Bloomberg commodity index is also coming off, so that idea of the growth is shrinking, certainly getting more visible in prices. Looking at indices, we were looking at the FTSE. I actually did get into the FTSE and out of the FTSE overnight. Basically didn't make any money, didn't lose any money. The reason why I got out, even though I got short there, is that US markets look strong. So go figure, is that this resistance level here looks like it's going to be broken. Why? Is beyond me. Maybe they're looking beyond the rise in interest rates, and that the free money or cheap money from the Fed and other institutions, China and Europe, is going to be back on the table. So why not buy stocks? Got me, I don't know. I've never really understood why the stock market gets stronger in times of like this. I think that that's going to be a painful little rally that we should be selling. Anyway, other than that, I don't see any major opportunities today. I'm still waiting for the US dollar to get down here and get that opportunity to get long the US dollar, and otherwise it's staying in the shorter time frames, just scalp trading effectively. So that's it for the day and for the week. You guys have a good weekend. Come visit our page, learn how to trade with our education course, or trade our capital up to 10 mil. Enjoy your weekend, guys. I'll see you Monday.